Hey everyone, Barry Brooksby here. Hope you're doing great. Today I'm going to debunk this video about insurance companies lying to you, infinite banking exposed. This is coming from the Money Guy show, and I think what you're going to discover is that they do not know a whole lot about infinite banking. They're using wrong numbers, they're using inaccurate illustrations. I don't even think they're using a true infinite banking design. So this will be fun to go through. You are going to hear that they talk about a lot of really good things with properly structured high cash value whole life insurance. A lot of that is spot on. But when they get into the infinite banking, the rate of return, policy loans, they're clueless. So they have not exposed infinite banking. Let's take a look at what they say.
I am so excited about this because this gets so much press and we get so many questions asking us about it. Guys, what about infinite banking? Is this what the elite wealthy do? Is this what the top rung of society is doing? Is this the secret financial thing that I need to know about in order to truly be a financial mutant? So in today's show, we want to unpack that.
Well, here's the thing that gets me is insurance is a very necessary part of the wealth building process. What I don't love is somehow in this modern world we live in, you cannot help but turn on social media and people will tell you 401ks are a scam.
Yep.
And it's typically followed by, because where you need to be putting your money is in life insurance, whole life insurance, and even bank on yourself through infinite banking. I'm just glad that we finally have been able to find an insider that would share the details with us so we could do this content. So stick around to watch all the details on infinite banking.
Is a 401k a scam? I wouldn't go that far to say it's a scam, but if you're putting all your money into a 401k and you're planning on that and Social Security in your retirement, you're probably not going to have as much money as your financial advisor or your HR department is telling you, because 401ks are subject to stock market volatility. You've got to pay all the tax on all the money when you do take it out. And there are hidden fees within a 401k. And look, if you're not getting a match on your 401k, generally, I don't recommend doing a 401k because of those issues I just mentioned, plus other things as well. You never want to be in a position where you're a few years from retirement and you lose 20 to 30% of your 401k portfolio. So it's not a scam, but there are some very misleading things about a 401k. If you're getting a match, most of the time, that's a great thing. It's free money, but be aware that the market volatility and the taxes are going to leave you with less than you have in the overall portfolio.
A great setup, Brian. What we've done is we actually have a listener out there that says, hey, actually, I do this. This is a strategy I perpetrate. And every time you guys talk about this, you're not actually using policies that are designed for this specific purpose. So we asked this friend of the show, hey, why don't you send us some policy design so we can actually do a side-by-side case study to see if this is merited. But before we get into that, for those of you who don't know, for those of you who aren't familiar, infinite banking or bank on yourself is a way in which you use whole life insurance to build up savings and leverage cash values for self-financing. It may be pitched as an alternative to putting your money in a bank or putting your money in the stock market. You instead get to be the bank. So that's the pitch. You no longer need a brick and mortar. You no longer need a financial institution. You yourself can become the bank.
All right. True diversification in a portfolio is different asset classes. 401k, IRA, brokerage account, stock market, right? There's that asset class. Crypto, gold and silver, real estate, a business, commodities, and cash value life insurance. You shouldn't have all of your money just in one of those asset classes if you want true diversification. But you also need to be aware that there's investor DNA. Invest in what you know. Many people out there investing in 401ks and IRAs are speculators. We're not in control of the mutual funds and the stocks moving in and out of there or ETFs That's a fund manager that's taking care of that. Invest in what you know. But if you're hearing from a financial advisor that you need to be truly diversified, yet all your money's still in the market, that's not true diversification. So we want to think about infinite banking and high cash value whole life insurance as a different asset class in your portfolio. And let me ask you this question. What do you have in your portfolio right now that's guaranteed, liquid, and tax-free? Most of you are going to say nothing. I have nothing that meet that criteria. Infinite banking, cash value whole life not only meets all of that criteria, plus a whole lot more.
Now, look, I want to play the part of helping you kind of walk everybody through this. And sometimes when I see definitions, it doesn't really tell the full picture, Bo. So how about a visual? Do you have a flow chart or a visual that can help people who maybe are the learners who go beyond the words?
That's exactly.
And by the way, wouldn't it be nice to be your own bank? That if you needed to access cash, you didn't have to go to a bank or a lender or the SBA and fill out an inch thick of paperwork and wait 45, 60, 90 days or longer to get the loan and put up collateral perhaps, and then provide tax documents and sign this and sign that, P&L statements, balance sheets. I mean, there's so much that a bank wants. You could get to the day before closing on a bank loan and they're asking you for more information. Becoming your own bank with high cash value whole life allows you to access cash within 3 to 7 business days. And they're not questioning you, what do you need the money for? And you are getting a loan from the insurance company. A lot of people out there are being misled in what they're saying and what they're teaching others in the fact that they're saying, oh, you're borrowing your own money. If you have a cash value whole life policy, you're just borrowing your own money. That's not true. You're borrowing the life insurance company's money. They're putting a lien against your cash value. You're still earning interest and dividends on your total cash value.
Exactly right. So here's what you do. You as a policyholder, you're going to pay premiums or send cash into a whole life insurance policy. It's going to be a life insurance policy offered by an insurance company that you're going to pay a premium into every month. Well, with that premium, one of two things is going to happen. Part of it is going to go by a death benefit. If you were to die, a death benefit would be paid out to your beneficiaries. And the other half is going to go to build up cash value inside of the life insurance policy. Well, as that cash value then builds, you as the policyholder can then borrow against it. So if you need to be able to have money to spend, rather than going to the bank and pulling money out of a bank account, you can instead use your life insurance policy as the bank to pull money out of.
Now,
and doesn't that sound so amazing? It's really remarkable. I've had policies for years and years. I take policy loans to buy real estate. I take policy loans to buy crypto. I've taken policy loans to buy cars. That freedom and that flexibility makes these policies extremely attractive and an asset in your portfolio.
I already noticed something that's a little concerning to me, Bo, is that when I talk about life insurance, I'm very familiar with buying term life insurance, which is primarily you are buying the insurance. If something happens to you, you get paid, but it doesn't build up cash value,
right,
meaning that there's not an element of investing or making the premium level in a permanent way. But I also noticed the thing that gets me, this says whole life insurance. Why don't you tell us what variables or factors are needed to really set this up? Because that's already a unique thing to be whole life insurance.
That's right. In order, and this is what we were told, again, by our insurance insider, hey, you got to make sure that you're buying the right type of policy. And so let's talk about the elements that make up this infinite banking policy. The very first thing that you need, the what you have to buy, is high dividend paying whole life insurance. Now, you immediately alluded to something, Brian. Immediately, our spidey sense goes off when we hear you have to go buy whole life insurance. Because we know all the time that we talk about term insurance versus whole life insurance. There's a very tangible reason why we like term insurance more.
Well, first of all, life insurance, I think, is a period certain need.
No, it's not. If you have a death benefit and you're using term insurance and you know it's going to expire, What does that do to your family legacy? What does that do to the assets that you have and the pressure that's going to be put on those assets to perform? So yeah, you can buy term insurance for 10 years, 20 years, or 30 years, but statistically, 98% of term insurance policies don't pay a death benefit. So if I said to you right now, hey, I want to sell you this product, and by the way, 98% of people never use it, would you buy it? Now, I'm not saying don't buy term insurance. I've had term insurance before. There is a need for it, particularly when children are still in the house and you've got debt and responsibilities. But whole life insurance is legacy planning. It's a guaranteed payout. You know, no matter when you die, there will be a death benefit that goes to your beneficiaries. So whole life insurance is remarkable in the sense you've got this guaranteed legacy. You can use it for estate planning, asset protection. There's so many benefits. So term insurance is okay, but it's like renting a house. There's nothing to show for it if you outlive it. Whole life insurance is like owning a house. It has equity. Anyway, some of the things that these guys are saying about term compared to whole life, you got to look at the details. There is a place for term insurance, but if you want a permanent death benefit with cash value, with equity, and a guaranteed payout, you got to go the whole life route.
Investing, you're building up your army of dollar bills. So hopefully at some point you become self-insured.
Self-insurance is a big myth. Maybe there are people out there that can self-insure if you're worth, 20, 30, 40, 50, $100 million. Most people should not be self-insuring. Again, I go back to what I said just a minute ago. It puts a lot of pressure on your assets to perform. You would leave your family with less of a legacy if you try to self-insure. And would any of you ever go self-insure your home? Of course not. Well, why would you self-insure your life? It's more important than your home or your car. So self-insurance, can it work? Very rarely. For most people, don't even consider it. It's too risky, and you wind up leaving your family with less than they could have had.
You don't need to replace your income anymore because your assets will talk for you or protect you and your loved ones. That's not what I'm seeing here, because when we talk about whole life, the premiums are substantially higher. And I know we even have some research on that.
Yeah.
All right. If you have a 20-year term insurance policy and you want to renew that policy 20 years from now because you need more death benefit, your premium's going to go up because you're 20 years older. Whole life insurance statistically is the least expensive form of life insurance. Why? Because you lock in a premium when you first get it and it never gets higher. The premiums never increase in a whole life policy. So over time, if you were to look at your life, say you lived to 90 and you had term insurance through the age of 90 compared to whole life insurance through the age of 90, you would have paid less for your whole life policy and you would have been able to leave a guaranteed death benefit. So is the premium lower initially with term insurance? Yeah, it is. But again, you're not building up cash value, and 98% of the time or more, that policy is going to lapse and you'll still be alive.
If you look at how much insurance coverage costs, and this is for a female in excellent health for a $500,000 policy. If you were going to go buy term insurance, it would cost her $188 at the age of 30. That same level of coverage for a 30-year-old would cost $4,000 a year. So $4,000 versus $188. Fast forward to a 50-year-old female in excellent health.
Using their numbers, I've put these into an Excel spreadsheet. We're going to talk about the details here, comparing term insurance to whole life and the cost throughout your life. They're showing the cost for a 30-year-old on a 500K term policy is $188 a year. 40-year-old is $283, 50-year-old $644, 60-year-old, 70-year-old. Now I had to go in and get the numbers for a 75-year-old because I wanted to take this out to the age of 85. And every 10 years, the policy's renewing. For a 30-year-old, they would have spent $1,880 over those 10 years. They've got to renew then, 10 years later. Renew, renew, renew. So over the course of that time frame, they would have paid $120,000 in premium for the $500,000 of insurance. If they live to the age of 86, the $500,000 term coverage, it's gone. It's expired. There's no more death benefit. And the full $120,000 that they would have paid in premium would be lost money. In their example, they're showing the cost for $500,000 of whole life to be $4,000 a year. So if we times $4,000 a year by the 55 years, there would have been $220,000 paid. Yes, $100,000 more would have been paid for the whole life policy. But how much death benefit and how much cash value would there be at the age of 85? Here's the $4,015 premium. At the age of 85, there's $1.1 million in cash value, and that $500,000 death benefit has now grown to over $1.3 million. So the question is, would you rather pay an extra $100,000 to have a guaranteed $1.3 million of death benefit? Sure, that seems remarkable. What if you cancel the policy at the age of 85? Well, the insurance company is going to write you a check for $1.1 million. So clearly this is an asset. It's a guaranteed death benefit because it's whole life. It doesn't expire when you turn 86. But let's take it one step further. What if you wanted to insure your life up to the age of 90? Now, you usually can't get term insurance. It's going to go to the age of 90. So I want you to remember this acronym. ART stands for Annual Renewable Term Insurance. So I'm showing the same premium amounts through the age of 70, right? Here's our $35,250, $35,250. But at the age of 75, now this person decides, I want annual renewable term because I want the term coverage of $500,000 to last until I'm at the age of 90. In this case, in adding all these premiums together, plus 30 through 75, you would have paid $343,000 of cost. In a whole life policy, if we take the $4,015 through the age of 89, right up to age 90, you would have paid $240,000. What's the death benefit in the whole life policy at the age of 90? It's $1.65 million. So not only did you pay less money to insure your life up to the age of 90, you have over $1.1 million more in death benefit coverage. Having whole life in your portfolio is going to give you more peace of mind, and it's going to give you cash value and your family more in death benefit coverage. We're all going to die. Why not have a guaranteed payout? That would be important if you want to leave a legacy. You also don't have to pay a premium your entire life in a whole life policy. There are options to fund for 10 years, fund for 20 years, fund through the age of 65, but we can also build in flexible premium options. Or check this out, you could let your dividend make your premium payment for you after a certain amount of years. So a lot of flexibility with whole life insurance. Now, especially with infinite banking, there's greater flexibility because of PUA, paid up additions, which turbocharges your cash value growth even more. Policies designed for IBC have a lot of flexibility, and you can choose random years when you want to stop funding. You don't have to decide that right in the beginning when you start the policy.
Specifically, you want to make sure that you're buying high dividend paying whole life insurance because you can use other types of permanent insurance, but dividend paying, or also known as participating policies, are the ones that work best. And there's a few reasons why they work best. Number one, the premiums don't go up as with other policies. So you can actually lock in a fixed premium for the life of the loan. The other big way that these policies are sold is that the cash values are guaranteed to go up. If you look at other types of cash value whole life policies, they have a guaranteed rate that says no matter what, we're going to make sure that this goes up. Not all cash value policies work that way. Some of them can actually decrease in cash value. But if you buy a guaranteed whole life policy, you can assure that you're going to have some minimum rate of return that you receive. Now,
yeah, this is great. I'm glad these guys are pointing this out. You earn a guaranteed rate of return every year. Cash value is going. It's not tied to the stock market. So what that means is every year you're making money. And if you have PUA to turbocharge the cash value growth even more, you're making more money. And dividends are paid on total cash value. So the more cash value you have, the more volume of interest and dividends you earn. So I do agree with these guys. You want high dividend paying, participating whole life insurance. So you earn the dividend. It comes back into your cash value, and then you're earning compound interest on that annual dividend that you're receiving.
Here's the problem, though. When it comes to buying whole life insurance, there are often a lot of very expensive commissions, very expensive fees that go into this. So Consumer Reports came out and said, hey, when we look at all the different cash value whole life policies out there, the average rate of return, and this is including the dividend payments, but with the guaranteed cash value built in, is only about 1.5%.
In the policies and companies I use, that's not true. And he just is describing traditional old style whole life. He's not talking about the infinite banking designed whole life. But you can watch several of my other videos. I go through old style whole life. And in the old style whole life that I show, there's no PUA, it's just traditional whole life for a death benefit. 4% or higher is the internal rate of return, not 1% that he's stating. So that statistic of all these companies, all these policies, we're very specific on companies that we use and have vetted. They have to be mutual dividend paying companies that have been around for 120 plus years. The returns are much higher than what he's stating.
So if you look at the average of all the policies out there issued, the average is 1.5%. Now we're going to talk more in a moment about how.
This is why it's important to look at your own numbers. He's talking about an average with probably thousands of different types of policies. Look at your own numbers, and we can see your rate of return right there on the illustration. So again, not a fan of the numbers that he's presenting here. This is definitely a little misleading.
We're going to try to use a policy that's custom built to satisfy infinite banking, but right there on the start, even though there's a guarantee at 1.5 or around 1.5 does not get me super excited.
That doesn't completely shock me, because whenever I hear the word guarantee, when you're talking about financial products, that's a heavy burden. That's a word, like I know when you're doing securities training, they tell you never, ever, ever use the word guarantee.
That's right. In securities, you would never use that word because you're dealing with market volatility. But these mutual life insurance companies, they have been in business for 120 plus years. They've paid dividends for over 120 plus years. In their contract paperwork, you have a guaranteed rate of return. I call this a guaranteed investment. You have a contractual guarantee with a mutual life insurance company that's A+ rated, AA+ rated. And all this comes because of their history. They know exactly what they can do in order to offer you a guarantee. And those guaranteed numbers are right in the illustrations that we provide.
Because that's something that, I mean, if you are taking on risk, that by its sheer nature is not, you're getting risk, you're taking a risk to reach a premium in return. There's a risk reward from that. A guarantee has to be at a lower price point, and that's why there's fees, there's lots of other things. That I completely get why a guarantee is going to be a much lower rate of return.
So the first thing, we're thinking about the elements that you have to have, is you have to have a high dividend paying whole life policy. The second thing that you have to have is a lot of cash. So this is a little...
Okay, you can have a lot of cash, and it's great if you have a lot of cash. But we have policy holders all over the country. I've done this for 25 years, clients in 49 states. Look, if you had $1,000 a month, you can start a high cash value infinite banking policy. But we also have clients putting in $100,000, $300,000, $500,000, $700,000 plus a year. So do you have to have a whole lot of cash to start a policy? No, you do not. So the way they started off this video was, oh, this is what the wealthy do. And this is what you've got to be able to be wealthy in order to have a policy like this. Nope. You could set up a policy for $500 a month, $1,000 a month, $2,000 a month. But the idea is get started with this asset that does grow guaranteed, that does provide a dividend, that does allow you access to cash, and you can use all that money 100% tax-free.
A little bit counterintuitive. In order to be able to execute an infinite banking or a bank on yourself strategy, you have to already be someone who can dump tons of cash into these policies. So right there off the bat, that's fairly limiting, right?
Yeah.
Because not everyone has a ton of excess discretionary cash flow.
Not true. So I want to clarify, this is not true.
That they can throw at this kind of policy. And so the question you may ask is, all right, well, why do I need that? What do I want to be happening with this tons of cash? Well, what you essentially want to have happen is part of the cash you're putting into the policy is going to pay for the premium. The other part, and the premium being what the insurance actually costs, the other part is going to go to building up the cash value. What you want to do by dumping as much cash into this policy as you can is you're buying paid up additions. And what paid up additions are entirely paid for life insurance additions that both increase the death benefit, increase the cash value, and thus increase the dividends that are paid out. So for infinite banking, this paid up addition is primarily used to increase the cash value as much as possible, so the dividends that pay on that cash value are as high as possible. No different than if you had a bank account and you want to put as much money into that bank account as possible so that the interest or the dividends you earn on that is as high as possible.
Now, wait a minute. When I watch the brochure commercials, everybody always says you put all this money in, but here's the benefit over investing. You get access to your money completely tax-free. Mm-hmm. How in the world... I mean, because you're making this thing sound like you're just paying for a lot of life insurance. That's right. How am I going to get access to my money tax-free, as I've often hear people talk about?
So when we think about the cash value increase and you're dumping this money in, and we look at the average dividend rate, the 10-year average dividend rate on cash value policies is somewhere around 5 to 6%. Some companies a bit lower, some companies a bit higher. But the thing that makes this exciting or gets people excited about is exactly what you said. You actually have the ability to take loans from the policy. So if you need money, if you want to access the capital, you can take a loan from the cash value that is, quote unquote, tax-free, where you can then use that money to go consume goods or to go buy products or go do fill in the blank. You are borrowing money from those copious amounts of cash that you've paid into the policy to build up that cash value.
No, wait.
And yeah, this is great. I'm glad they're pointing out it is tax-free if done correctly. And there's some things you got to do, but we take care of that for you. Use money, use all the gains, use all the growth of cash value, 100% tax-free. That's incredible. As I talked about earlier, what do you have in your portfolio that's guaranteed to grow every year, where you have access to cash and you can use that money 100% tax-free? So this is a good point, but let's see where they go with it from here.
My spidey senses are starting to tingle a little bit here, and the fact that leverage is not something that taking on encumbrances don't tie into financial independence, because those.
Okay. Listen to what most wealthy people say and watch what they do. They leverage assets. Leveraging is a huge part of growing more wealth. Look at the major companies out there that have debt. Apple, right? They have debt. Well, why do they have debt? If they're a $1 trillion company, they use debt to grow the business. Leverage is huge. So if you're a real estate investor and you have equity in your real estate properties, you can take out a refi, right? Do a cash out refi, use that money to go buy more real estate. What I tell people most of the time is, number one, take policy loans to buy assets. Take policy loans to increase your wealth, cash flowing assets, whatever it might be, buy assets. Can you pay off debt with it? Yes. Can you go buy consumables? Yes. But the number one reason to take policy loans is to invest in assets and create more wealth. So This idea that he's saying don't leverage, that's ridiculous. That's what the wealthy do. It's what corporations do.
Those two words, independence, encumbrance, those just don't work. How are you going to make this work where I'm taking loans? Because aren't I paying interest rates on this stuff, Bo? I mean, there has to be a catch here.
That's exactly right. So a lot of these loans do indeed have interest rates that you're paying. Now, before we go into the interest rates that you pay, there are two different types of loans you ought to know about. There are what are called direct recognition loans, which means when you pull the money out, you don't earn any money, you don't earn any dividends on the money that you've pulled out.
Okay, we're going to skip over some of this because what they're saying is not true. I'll keep it simple. In a direct recognition company, at least the companies that we use, we vetted and we only use the top companies. Direct recognition companies that we use and non-direct recognition companies that we use, you still earn interest and dividends on your total cash value. So what he's saying here is not true, not with the companies that we use.
However, you've already alluded to this. These loans do bear interest. Well,
interest on the loans could be 5%, could be 6%. I've seen it as low as about 3 up to 7 in my 25-year career. But remember, you're still earning interest and dividends on your total cash value. So you are paying interest. It's going back to the insurance company, but you're still compounding on your total cash value. In most cases, you come out ahead because of that compounding.
I've watched a lot of social media. I've never heard a lot of people talking about direct recognition, non-direct recognition, wash loans.
Awfully complicated.
This stuff, I mean, my head's spinning a little bit on this. So,
all right. In a nutshell, I've mentioned non-direct, direct recognition. This should not be a key factor in the policy that you go with. What most agents don't know, so what I'm about to tell you, 95+% of agents don't know. When you have a direct recognition company, everyone earns a little higher dividend. In a non-direct recognition company, everyone earns a little lower dividend. When you take a loan in a direct recognition company, you earn a little bit less of the dividend. You still get the dividend, but you earn somewhere between 0.65% and 1% less of the dividend. So it is not true that direct recognition companies don't pay a dividend on loan money. Companies I use certainly do. And he mentioned a wash loan. You earn an interest rate in the policy plus the dividend. And yes, there is interest that you pay back to the insurance company. For them to say it's complicated, I'll tell you what's complicated is an IUL, an Indexed Universal Life Policy, which a lot of financial advisors sell. There are many moving parts in an IUL or a VUL, but in a whole life insurance policy, it's simple. You have a fixed insurance cost, you add PUA, paid up additions, to grow more cash value, and you take loans when you want. It's a fully guaranteed product. Some of the things that these guys are saying are not accurate.
My head's spinning a little bit on this. So because this is not anywhere that I'm seeing on social media, maybe we ought to take a few steps back and at least, why don't you bring this back to what are the benefits they're at least telling me I'm going to get out of this? Because right now the details are making me feel like I'm swimming upstream on this. So at least let's break it back in a little elementary, a little more.
And the problem he's feeling like he's swimming upstream on the details is because the details they're presenting aren't accurate. So of course there's going to be some confusion.
More elementary. Tell me what the brochure says the benefits are.
So let's look at the brochure. Very first thing, we already said this. They tell you, hey, the dividend rate will be 5 to 6% or more each year. And if you look at the 10-year average dividend, so you can think about that kind of like interest rate on your savings account, dividend rate on your cash value, somewhere around 5 to 6%. Returns on the policy are guaranteed. So that's not like investing in the stock market. In the stock market, the market can lose money. It can go down. If you have a cash value, whole life, high dividend paying policy, there's likely going to be some guaranteed rate in there. So your money can't go down in value. So a lot of people like the security around that. So that's another brochure benefit.
There's got to be a catch to that. I know you're going to cover the catches in a minute, but there's got to be a catch to tell me I can make 5 to 6% guaranteed, because we have it in all caps for a reason.
He didn't say that. There's a guaranteed rate of return and you earn a dividend. The dividend is not guaranteed. Insurance companies I work with, they've paid dividends every year, as I mentioned, for over 120 years. Don't ever think the dividend is guaranteed. It's been paid for over 120 years, but it's not guaranteed. And they do show that in the illustration. It's a non-guaranteed dividend.
There's got to be something more to it.
Let's keep going with the brochure, though, because the other thing to say is, hey, not only do you build this cash flow, not only do you have this capital that you can use, life insurance also offers protection for your loved ones in case something were to happen to you, and it's there forever. It doesn't go away at some point in time. So not only do you have this bank that you're building where you can get the money out, but your beneficiaries, your loved ones are taken care of if something were to happen to you. And I think this is the biggest benefit that people really, really dive into this. Your money will be accessible when you need it. Unlike a 401k plan where you have to wait till retirement and you can't access it until you're old and decrepit. So this is what they say. Healthy dividend rates, guaranteed rate of return, life insurance protection, and you can get to the money when you need it.
Who doesn't want those benefits, right? Those are amazing. So I'm really glad they're going over the brochure analogy here to show the benefits because they're spot on.
We've done this all wrong because you spent the first 10 minutes going through all these definitions, complications. You should have started here on the brochure. This is good. I mean, I can get behind this. This sounds really good.
This should sign up for
5 to 6% guaranteed. I get life insurance for my family, and I can actually get access to the money. What could go wrong? This sounds perfect. I can see why this is what I'm finding on social media.
But now let's talk about the reality. In reality, only the cash value is growing at the dividend rate. So we're going to show you a case study in a moment where all that money that you're throwing into this whole life policy, not all of it's going to cash value. And so not all of it is getting the dividend rate applied to it. Even
in a properly structured whole life policy, most of your premiums going to cash value. That's what we want. So yes, the more cash value you have, the larger volume of dividend you earn.
in the early years, you're not really building up very much cash value at all.
And that isn't true. Not in a properly structured policy. If you've got a policy with PUA and you're focused on an infinite banking design, you've got huge amounts of cash value in the first year. 70%, 80%, 90% or more of your premium in first year cash value.
So maybe it's not as great as just a savings account right now paying 5 to 6. There's one piece. The second piece is if you want some of these bells and whistles like non-direct recognition loans where you can take a loan and still earn dividends, or if you want wash loans where you can make sure you never have a disparity between the rate you're paying and the rate you're receiving, it's going to cost more. They're going to lower the dividend rate that you receive on that.
So these are all the things that have asterisks on them.
These are all.
And as I mentioned, it's 0.65% to 1% less of the dividend. You still earn the dividend. And these guys just said your savings account earning 5 to 6%. There's not a savings account out there earning 6%. I mean, it'd be great if there was, but there isn't.
All the asterisk things.
Okay, keep going.
How about this one? Fees and expenses can eat into your return. Nothing we've talked about right now actually covers the mortality expense fees or the commissions that are paid on these types of policies. That's a whole separate subject that we're not even broaching here.
I'll say this. When we look at an illustration, all the numbers are net numbers of fees. And if you're breaking even on your cash value in the third year, fourth year, fifth year, sixth year, etc., from then on, it's all profit. So the fees are very, very low in a properly structured whole life policy. And the illustrations are showing you the net numbers after fees.
And then this one is a big one. Surrender fees typically don't go away until you've had the policy for at least 10 to 15 years.
Okay, this is where these guys are completely wrong. Whole life insurance doesn't have surrender charges. The fact that they even put this in the slide shows how ignorant they are relative to whole life insurance. They're talking about IUL or VUL. Those types of policies have surrender charges. Whole life insurance does not have surrender charges. This right here is completely false.
So what happens is you're signing this insurance contract saying, yes, I'm going to perpetrate this strategy. But if I change my mind and I decide I want to move away from this, if I want to get out of this at some point in the future, I'm going to be penalized from doing that. Well, all of a sudden that makes it sound like, well, maybe this isn't my money. You know, at the bank, if I don't like my bank, I can pull my money out and I can go choose a different bank. With the insurance policy, if I decide to pull my money out, I get penalized for not carrying in my part of the agreement.
Again, this is wrong. Okay, what they're saying here is absolutely wrong when it comes to whole life insurance.
Go back to something we covered a little earlier. If the Consumer Reports found the average rate of return is 1.5%, that has to mean that people aren't getting the 5 to 6%. Because we even
Certainly
went and
not.
pulled back when Consumer Reports came out with the article. Some of the dividend rates were actually up as high as 7%.
Yep.
So it's not like this is a different interest rate environment or things have changed a lot in that aspect. What I think is interesting when I started doing a little deeper dive on this, if you need your money in the first 3 years, that surrender fee is going to eat you alive because a lot.
Not true. If you have a properly structured whole life policy and 90% of your premium is showing up in cash value in the first year, and you're breaking even in the third year or fourth year, means all your money that you've put in is available in cash value. So these guys, again, are ignorant in regards to properly structured whole life. And they're saying infinite banking exposed. They shouldn't be saying infinite banking exposed. They're acting like they know about infinite banking, but in a properly structured infinite banking policy, much of what they're saying is false. It's inaccurate.
Is going towards commissions and other things. So there's going to be a steep surrender fee. So that's controlling your ability to vote with your feet on the front end. And then if you live to be a ripe old age, and the back end is going to get really crushed because the cash value is actually going to be paying the much higher cost of insurance. Am I reading this right?
Yeah, that's right.
So you don't really, this banking on yourself actually has a lot of asterisks and catches, is what I'm hearing. And by the way, if I can, for all the people who say putting your money in a 401k is putting your money in prison because you can't touch it, and this is a better way. How do you get past the surrender fee?
Because there are no surrender fees. Come on, you guys. Understand what whole life insurance is about. If you want to do a separate video about IUL or VUL and talk about those problems, you'd be more accurate there. But this is whole life insurance. Infinite banking, properly structured whole life, don't have these problems you're talking about. So yes, if you put your money in a 401k and you are locking that money up until you're 59 and a half, and let's say you're 30 today, that's nearly 30 years of putting your money in prison. What we're saying is if you have a properly structured whole life policy, you can access that cash prior to 59 and a half with no early withdrawal 10% penalty, no tax, and you can access that cash 30 days after the policy's in force.
Call this Alcatraz. If putting your money in a 401k is putting it in prison, putting in this feels like you're putting it in Alcatraz. Something that can't be broken
This doesn't tie to what I'm seeing out there.
And then this is what you just alluded to. This money is locked into a complicated insurance product. So all of us can kind of understand if I have.
The complicated insurance product is IUL and VUL. Index Universal Life, Variable Universal Life. Whole life insurance, it's been around for over 200 years. And it's the safest place to store money. It's why banks, major corporations, and the wealthy have cash value insurance. They know it's protected. They know it's guaranteed. They know it's liquid. And for your purposes, I'm going to teach you how to use the money and all the gains 100% tax-free. So this is inaccurate as well. It's not complicated. You're talking about a different insurance product.
I have my money in a bank and I have it in a savings account. I need to go get it. I can go get that money and I can get statements on that and understand what's going on. Well, now we have this alternative to that has a lot of asterisks, but maybe the numbers will be compelling. Maybe when we look at an actual policy that's actually been designed for this strategy, maybe then it's going to click. Maybe then we're going to say, aha. So let's look at a Money Guy case study where we actually test the numbers using a real policy designed by a real insurance agent. So let's assume that you have Infinite Banking Isaac. And Infinite Banking Isaac is going to put $10,000 per year into a high dividend, whole life paying policy in order to carry out infinite banking. That's what Isaac's going to do. And so the dividend rate we're going to assume, which is the dividend rate as of right now in 2023, is 5.2%. And the non-guaranteed values assume that this rate stays constant for the entire life of the policy. What we're saying is we're going to lock in 5.2%, and we're going to assume it does not go down even if interest rates fall. So we're trying to stack the deck in favor of the illustration. Make sense? All right. We're also going to say that by the time, since we're doing paid up additions, since we're buying more insurance, at age 65, the non-guaranteed cash value, this is from the illustration that an insurance agent actually provided for us, the non-guaranteed cash value will have grown to $532,000. The non-guaranteed death benefit at that time is $897,000 at age 65. Now, this is an important thing to mention. When Isaac first started buying this policy, remember the whole idea is I'm going to dump a bunch of cash in, I'm going to buy paid up additions throughout the life of the policy. When he first took the policy out at the very beginning at 36,
age 36,
it was only a death benefit of $196,000.
Okay.
So that $196,000 death benefit over the next 30 years grew to be $896, but it didn't start at $896 because I think that is something worth noting. His cash value by perpetrating this strategy went all the way up to $532,000. So the question is, what does his investment return look like?
Now, before you give us the aha moment, I want to make sure I put it out there. First of all, thank you to the life insurance agent that was willing to come forward and just share it with us. I mean, because it's hard to get information on these type of products.
No, it's not. And he's saying, thank you for coming forward. It's easy to get this information. Talk to an infinite banking practitioner. I can get an illustration to you within the next hour. So it's so funny how they're making this sound secretive and no one understands this. I've done this for 25 years. I've designed thousands and thousands and thousands of illustrations and put into place thousands and thousands of policies. So it's easy to find if you're looking in the right place. And we're going to do a comparison with my numbers here in just a minute, but let's look at their aha moment.
So to actually have somebody come and say, hey, I use these. I think I'd love to get your take on it and share it. We're not doing this just to straight up just rip it up. Mm-hmm. We tried to give it the best scenarios we could. I mean, let's face it, timing wise, interest rates are at the highs they've been in the last 30, 40 years. That's probably a great time to lock in guaranteed type returns. Sure. We tried to give it some benefits of the doubt on that. And we didn't pull any money out. So with all of that, and then thanking the insurance agent, what's the rest of the story?
So here's the rest of the story. Over this 30-year time horizon, if you look at the $300,000 that was paid into the policy and the guaranteed cash value of $532,000 and the guaranteed death benefit of $896,000, the actual rate of return that was received in this policy, 3.62%.
3.62% is a tax-free number if done correctly. So what would you have to earn in the 401k or IRA or mutual funds to net down 3.6%? Probably 5 to 7 depending on your tax bracket. But then you have to factor in the volatility that you might have dealt with in the 401k or IRA. So I'm going to show you something better here, but regardless, this is a net tax-free rate of return.
Over this 30-year period, when you think about the return on capital that was deployed into this policy, 3.62% does not get me super excited. And this assumes you didn't actually use it for the number one benefit that's touted from it, which is borrowing money from the policy through time.
And now, I know earlier you showed it on the assumptions page. This thing was paying over 5%. Mm-hmm. So for it to have returned 3.6, is that because it's back to what you said? You're only earning off the cash value, yep. And then that's net of fees and all the other things that are coming through.
There are fees coming through, and then
or the agent didn't structure it correctly. That plays a role. You can have the right company, you can have the right type of product, but if the agent doesn't structure the policy correctly, you can still have a policy that lacks performance. There's not just one variable. There are multiple variables that you have to get right, which is why you want to be working with someone that is specifically knowledgeable and educated in infinite banking and the Nelson Nash Infinite Banking Institute with that certification. And by the way, my new book, Live Rich, Die Rich, So much of this is covered. I highly recommend you read it. I recommend you get it. It's available on Amazon. It's new this year. And I go through a lot of these details, but I also go through tax-free retirement income. I go through legacy planning. So many things across the board of someone's financial life. And I named it Live Rich, Die Rich, because I want people to recognize it's not just about money. We want to live rich spiritually, physically, mentally, emotionally. All those things come into play because if one of those is out of balance, it can throw the other areas out of balance as well.
Every single year, every single month is paying for the insurance. So it's not like you had all $10,000 working for you or all $10,000 having that 5.2% dividend rate applied to it. Now, again, these are not numbers that we did. This is from an actual insurance policy. We just calculated the rate of return, 3.6% over the 30 years.
Okay, here's my design. $10,000 a year through the age of 65. This is structured correctly. Cash value, $711,000, not the $531,000 they're showing. And look at the death benefit, $1.325 million, not the $800,000 they're showing. Internal rate of return on this, 5.11%, tax-free. And the return gets better. By the time this person is 85 or 90, it's over 5.25% in tax-free returns. What they're showing at 3.62% isn't how I would design a policy. We want to be more aggressive with cash value and PUA, but you're seeing the numbers right here. How good is 5.11% tax-free? That would be like earning 8 or 9 or 10% in the stock market without ever having a losing year, ever. And we know that's not how the stock market works. What I'm saying is having a properly structured whole life policy in your portfolio is going to give you more peace of mind. Think about it. It's guaranteed, it's liquid, it's tax-free. Most people don't have that in their portfolio, but they want it. Here we're showing amazing returns. You've got access to cash prior to 59.5, and the death benefit is growing. This isn't a stagnant $500,000 death benefit. You get a growing death benefit that you can then use for legacy. So the benefits go on and on and on. A lot of what these guys are talking about is not accurate, and they're not even talking about whole life insurance. They think they are. They think they're talking about infinite banking. But many of the problems they're discussing have to do with a different type of life insurance, IUL and VUL. So we always encourage you, take a look at your own numbers, see how a properly structured whole life policy will work for you.